MPC preserves policy flexibility, avoids knee-jerk reaction. The status quo on the key policy rates and the neutral stance maintained in the current meeting by the Monetary Policy Committee, MPC, the six-member rate-setting body of the Reserve Bank of India, RBI, was no surprise. The RBI commentary, while retaining policy flexibility amid exceptionally high uncertainty, was justifiably cautious and vigilant. The RBI's articulation of supply-side shocks, weighing on both price and demand, and its conscious choice to avoid preemptive rate action, lent the current policy added significance as a meaningful reset of expectations. Accordingly, the one-year overnight index swap OIS curve softened sharply by around 29 basis points during the day, and over 45 basis points during April, as the possibility of an imminent rate hike faded significantly after today's policy. Going ahead, the growth inflation outlook is heavily contingent on the duration of the West Asia conflict and the extent of damage to energy infrastructure and cross-border economic activities. The recent two-week U.S.-Iran ceasefire and the reopening of the Strait of Hormuz are clearly positive developments, but a sustained easing of global uncertainty will hinge on concrete progress in diplomatic negotiations. Even though external conditions pose a significant risk, the RBI pointed out that the pause was also cushioned by resilient momentum in domestic activity across manufacturing and services. It projected 2025-26 economic growth at 7.6%, while sequentially moderating 2026-27 growth estimate to 6.9%, reflecting the possible spillovers from external headwinds. While headline Consumer Price Index, CPI-based inflation remains contained, supported by comfortable agricultural buffer stocks, strong Kharif output, and excise duty cuts, the RBI highlighted rising upside risks as higher energy and commodity prices impacted input costs, alongside emerging weather-related risks from a potential El Niño. The central bank accordingly raised its 2026 to 2027 inflation projection to 4.6%, with a visible pickup expected in the middle of the year. The RBI reiterated its commitment to ensuring sufficient liquidity after infusing durable liquidity of around $3.5 trillion through open market operations, OMO purchases, and $20 billion in forex swaps in 2026 so far. The recent administrative measures augur well for credit flow to productive sectors, like industries. Weighted contribution of industrial credit to overall bank credit has started inching higher in recent months, from a markedly low print about 6 months ago, and has scope for further expansion. In sum, the RBI commentary clearly acknowledged the deterioration in global growth inflation dynamics, while consciously avoiding overreaction, given the domestic economy's comparatively resilient fundamentals. Through a demonstrably balanced policy outlook, the RBI effectively alleviated market concerns of a knee-jerk response, a reassurance evident in the softening of the OIS curve. The current policy configuration thus reinforces a wait-and-watch stance, with the balance of risks tilted towards supporting growth rather than prematurely constraining it. Importantly, even in the absence of a policy rate action, the RBI retained a broad and flexible toolkit, encompassing calibrated liquidity operations, targeted prudential measures, and discretionary foreign exchange interventions, allowing it to aid credit transmission, manage the rupee's volatility, and preserve orderly market conditions.